Westpac is now forecasting a 4.85% cash rate for a buyer. That means a bank stress test near 10%. That isn't a hurdle, that is an absolute brick wall. And the real feel on the street is that values have already pulled back by 10%. Sellers, well, they aren't fighting the house next door anymore. They're fighting the next RBA's 3 board meetings. Well, hi there, folks. It's Matt Hayson here. And as we close off March and we head into the Easter break, I want to be very direct with you. In my 30 years of working in the Sydney property market, I've seen it all. The dot-com crash, the GFC, and the pandemic, but I've rarely seen a shift in conditions as swift or as sharp as what we've witnessed over the last few weeks. Today, well, I'm weaving through the lagging media reports and to give you the raw, real feel of what's happening on the ground. Now, the conflict in the Middle East is on everybody's mind, and excuse the pun, it's poured fuel on the fire. Rates, well, we already knew they were rising and the market was somewhat cooling, but this has acted as a massive accelerant. What may have been a very soft adjustment for property is now a very sharp shift. Many think if the war ends, the market will probably bounce back, but let's be real. 5 years now after the pandemic, we're still managing the inflation chaos that was caused by that era's loose spending and emergency rates. We're still paying that bill today, so I can't see a quick transition out of this situation either. Treasurer Jim Chalmers is now warning that inflation could hit mid-5s or even 6% by June. That is already somewhat baked in, and it's miles above the RBA's 2 to 3% target band. Now, this has forced many backflips from the major bank, including Westpac, who is now forecasting a 4.85% cash rate by year's end. Now, for a buyer, that means a 7.5% mortgage level and a serviceability buffer near 10%. This is a brick wall for borrowing power. Now, let's talk about pricing. The latest Cotality data is in, and Sydney is down 0.2% for the quarter. But interestingly, the prestige market of the East is seeing a sharp 4% decline. But the data, that always lags. It's like a weather forecast telling you it's 20 degrees outside, but it really feels like 15. Well, for us, the data says 4% in the East, but on the street right now, we're feeling and seeing more like a 10% correction on many properties. The proof? Well, ANZ Roy Morgan Consumer Sentiment Survey, that just landed this week at a near 60-year low. We haven't seen Australians this spooked since the early 1970s. Even more telling, last week's final auction clearance rate in Sydney landed at just 38.84%. We're now trending with the same consistency we saw in 2022, right before Sydney property prices corrected by 9%. Now, this isn't a theory, this is the trend line that we're on. This has created a massive disparity. Sellers, well, they want yesterday's prices. They're looking at the results in the rearview mirror, but even February results are a distant past. That data is now somewhat unreliable. Buyers, well, they want tomorrow's prices. They're weighed down by record low consumer confidence. And the gap between the buyers and the sellers is now a canyon. Sellers, they are chasing the market down just to find that elusive result. Now, Easter, that offers us a reset, but the market dynamic has changed. Sellers, they need to stop looking in that rearview mirror. This is an entirely new market in play right now. And buyers, don't sit idle. Markets find a new balanced price level very swiftly. And in the 30 years I've seen, no one has ever picked the bottom of the market through planning. It's often just been luck. Now, align with the feedback, look through the windscreen to get the right outcome in today's property market. So, thanks for tuning in. I hope you all have a wonderful and safe Easter break. We all need that reset, and I'll catch you all next week.